Welcome to the QuintArth Week in Review for July 3rd. Today, we are looking strictly at the underlying math driving the week's headlines, from billions fleeing digital asset ETFs to the hidden fee structures and administrative penalties quietly draining Canadian retirement accounts. Across both decentralized networks and traditional portfolios, retail investors are navigating a landscape of hidden structural mechanics, where a lack of precision leads to the permanent erosion of wealth. This chart displays weekly flow data for U.S. spot Bitcoin ETFs. For the week ending June 26th, these funds shed $1.79 billion, the second worst weekly exodus since their launch in January. This institutional outflow coincides with immediate macro stress, as a $10.6 billion Bitcoin options expiry on June 26th threatened to erase 12% of positions in 24 hours if the asset dropped to $54,000. This rapid exit has left a mark on retail participants. According to The Block, the average investor in BlackRock's IBIT ETF is now down roughly 40% from their initial entry point. The risks extend beyond spot ETFs into decentralized finance. The EigenLayer network currently holds $15 billion in total value locked, but for the average 10E3 staker, that massive liquidity pool hides an isolated exposure of $16,000 to a single correlated slash event, a risk window that opens with every new block the network secures. Whether holding mainstream ETFs or participating in complex restaking protocols, crypto investors are currently absorbing severe downside volatility and uncompensated tail risks. Moving to traditional portfolio construction, paying for convenient, automated financial advice carries severe, long-term mathematical consequences. A standard Wealthsimple managed account charges a total annual cost of 0.67%, combining their 0.5% management fee with underlying ETF expenses. For comparison, the VGRO All-in-One ETF provides the exact same diversified market exposure for just 0.24%. This chart compares those two fee structures over 3 decades. That small fraction of a percentage point mathematically compounds into a rapidly diverging gap, which ultimately costs the average investor $84,000 over 30 years. Similar structural leaks exist in Canadian retirement planning. Taking default RRIF withdrawals costs low-income seniors up to $5,000 per year in guaranteed government income. By year 3, that is $15,000 permanently erased from their retirement base. Timing to fix this error is strictly limited. Once an investor turns 71, the restructuring window to adjust these accounts permanently closes. Administrative oversights are just as costly for defined benefit pension holders. The wrong move regarding the pension adjustment, located in Box 52 of your T4 tax slip, quietly triggers a $1,848 annual CRA penalty, costing exactly $154 for every month the error sits unfiled. Canadian tax and retirement planning requires strict administrative precision. Relying on default assumptions and leaving paperwork unchecked yields highly punitive financial results. Whether you are navigating uncompensated tail risks in a crypto network, the compounding drag of a 0.67% management fee, or an unfiled Box 52 error on a T4 slip, wealth preservation demands rigorous active attention. Calculate the true percentage costs of your portfolio, strictly audit your tax slips, and ensure you are actually compensated for the risk exposures you hold.